Video yesterday shared with you the work I'm doing to analyze stocks in light of the increasing interest rates and how it will put some of them in jeopardy as their debt service goes up. So in essence, everything depends on the amount of long-term and short-term debt they have when it matures and the effects it's going to have on their overall earnings. And I just this morning saw a gentleman interviewed on Squawk Box who put it very clearly. You're going to hear him say that a 1% increase in interest rates is going to have a 10% effect on the performance of a stock. Listen to this, understand it, and then I'll show you how you can analyze stocks to make sure you don't get caught in this trap. The stocks are going down as interest rates are going up. We experienced this in the Silicon Valley bank failure and several others, and nobody was paying attention to it until they got hit in the nose. Well, get ready to get hit in the nose again, and this is not financial advice. This is the best financial education you're going to receive over the next 6 months, and it could save you a buttload of money.
Best of Us Investors presents Kerry Griegmeyer.
When you look at interest rates, 1% increase in our models for the discount rate, it's about a 10% headwind to valuations. And if you look at where these stocks have come from, kind of their highs this year.
1%.
1% change in rate.
Do you understand what he just said? A 1% change in rates equals a 10% drop in equity value. Well, I told you about that yesterday, how it's going to really depend on how much long-term and short-term debt a company has, and then the ability to pay off that debt is going to affect their prices.
That's correct, in our models, give or take a little bit.
So what is your Fed model at the moment for where things go for the next year? Because that would actually have a huge impact on this 10% impact on the equities.
It would, and I would say we're not bond experts. What we try to do is really focus on being tech experts. And instead of predicting interest rates, we're trying to look for stocks within the Mag 7 that actually have catalysts that could buck the interest rate trend if they keep going higher, or if rates go lower, you get an even better push on that catalyst. Google, for us, is the Mag 7 stock that has the best catalyst.
Google, for us, is the stock that has the best catalyst. Why is that? It's because of their financial situation. I'll show you exactly why he's bellying up for Google.
The thing that I can't figure out between Microsoft, Amazon, AWS, Google, and the like is whether we fundamentally think that the AI technology, which is spectacular, I mean, it's just beyond spectacular, creates demonstrable value for these companies, or ultimately is something that becomes a commoditized product that everybody has to have, that's part of the business, and ultimately becomes almost a defensive piece of it in terms of owning market share. Yes, Copilot will cost you 30 more, and yes, there'll be incremental dollars, but that it doesn't actually change the ecosystem fundamentally.
We think it will. And I mean, the reality is, if you rewind the clock 20 years ago, I think we had the same questions about the internet. Does the internet create actual, real, incremental value? And for us, AI is the same thing. Every company will be an AI company in the next 10 years, just like every company has become an internet company. And I think the providers of the infrastructure, the providers of the tools that do that, including the Mag 7 stocks, will benefit.
AI will affect our world just as the internet did some 20 years ago. That's where I'm at. That's where the Bus 12 and Bus 13 portfolios are.
And your gamble is Google is the winner.
We think Google is one of the winners. That's our top holding across Deepwater's funds. Like I said, we think they have this catalyst that's incredible. It could result in a higher multiple if investors start to apply more duration to Google's business.
Why is he buying Google? Why does he think Google is the strongest? I think I know why, and I'll be happy to share it with you.
Who on the Magnificent Seven do you not keep on your list? Is there one or two that you're just like, we're not into that?
We sold Amazon earlier this year. It was a stock we owned for a while. That's one where, again, it's a great business. All these are great businesses, so there's no bone to pick with them. For us, it's a matter of selection, and we want to own the ones that we think have the best opportunities over the next 1 to 3 years relative to the others. Google and Meta are those two for us.
Why did he say he sold Amazon? probably sold Amazon for the same reason I sold Amazon. And I think I can share with you exactly why he did. Okay, let's start with why did he sell Amazon? And let's start with Amazon's balance sheet. This is something I have access to that I'm getting very deep into. Let's page down here and look at Amazon's debt situation. As we can see, they have little or no short-term debt. This is their long-term debt. I want you to go back to 2016. It was $7 billion. It's now $140 billion. Well, why is that? Well, look around your neighborhood. Did you see the distribution centers they have started building probably back here in 2016, and that they have accumulated the debt to pay for the building of these? Well, this is okay if they can pay that debt off, because remember, as he said, as interest rates go up, the debt service goes up on this $140 billion. As it goes up 1%, it will have a 10% effect on Amazon's price, okay? That's why he sold it. That's why I sold it. Now let me take you to their income statement and show you the effects of this. This is Amazon's interest expense. Go back to 2017. It was $848 million. It's now $2.367 billion. So as they go to pay this, or to the debt service is going to take away from their earnings when they make their earnings report. As he said, for every 1% it goes up, their value comes down 10%. So now we have to be thinking about how quick does this debt mature, or how quick does it reset? And that's what's going to happen starting this next quarter for probably the next 3 years. Now let's go back to the balance sheet and see what Amazon's cash position is. As you can see, it's grown, but it's nowhere near the amount they owe. They cannot pay off that debt with the cash they have on hand. So that's why he sold, and that's why I sold Amazon. And that's why I'm doing this analysis for every stock I own, and then I'm going to do the same analysis for every stock in the S&P 500, because I've bought the software that I can pull these numbers and put them on a chart. I showed you the chart yesterday, and I can tell you exactly what's going to happen to their stock price based upon the amount of debt that they have. Now let's look at Google. Okay, this is Google's income statement. So let's page down and see what kind of interest expense do they have. Well, they started in 2016. That was about 109, and it's tripled. It's up to 357. So should we be worried about Google as well? Well, let's look at their balance sheet. This is their balance sheet. This is their short-term debt. As you can see, it has gone up from 16 million to 2.4 billion. And its long-term debt has gone from 3.9 billion to 27 billion. So why aren't we worried about them as well? And there's the answer. Their retained earnings are $195 billion. They've got enough in retained earnings to pay down or pay off that debt if they need to. Amazon doesn't. That's why he's high on Google. That's why he sold Amazon. And that's what I'm doing. And that's what I'm doing to analyze all the stocks in the BUS 12 and BUS 13 portfolio, so I know how much, if, again, I'm going to repeat what he said, for every 1% in an increase in debt service, there is going to be a 10% drop in the price and the value of the stock. So if you know what the debt service is for every stock you own, you can predict the price of the stock next year, the following year, as their debt matures. The only thing is going to change this is if interest rates come down. And Jerome Powell will tell us that, and that's when we change our strategy. I'm Kerry Grinkmeyer. I'm the host of Best of Us Investors. I used to be a guy who just basically bought stocks based upon what he thought was going to happen in the future. Now I buy stocks based upon what I know is going to happen in the future. And it's controlled by financials, and then it's influenced by technicals. And at Best of Us Investors, we give you both. So how do you get involved with us? How do you get access to this information? You come to Best of Us Investors. You see the where you can join our platform. On our platform, you have access to all this information. You have access to when I sold Amazon, when I buy Google, when I sell other stocks, because I'm digging deep into their financials. Mark's digging deep into their technicals, and we'll tell you the time to buy, the time to sell, and the time to hold. And that's what it's all about. Now, you may say I'm flip-flopping. No, I'm educating myself by necessity because I want to react to the next financial crisis. And it's at our doorsteps. You just need to have the information available to you is who's going up and who's going down. Come get on the bus.